Thank you for joining us. It's a great pleasure to have with us Barry Pasikov, the managing member of Hazelton Capital Partners. Barry, welcome.
Thank you. Thank you for having me.
Great to have you on the program, and we're going to talk about options today.
Sure.
And how equity investors can employ options in their investment approach. Before we do that, tell us a bit about yourself, how you got interested in investing, and particularly in value investing.
Right, so I started investing or trading right out of college. I was first on the Chicago Mercantile Exchange. I was trading down there in currencies and euro-dollar options. And I did that until about 93, left the floor, I went with a bank, traded with them for a while. And then I spent a couple of years in Singapore, a couple of years in Toronto. I came back, was with an option group, traded mostly volatility traders. So what we're looking to do is buy cheap volatility, sell expensive volatility with a mean reversion to the mean. And did that for about 2 years, started my own fund, doing the same sort of strategy. And then around 2007 I left the partnership. And I formed, in 2007 when I left my partnership, I was focused on trading my own account. And then in 2009 I launched Hazelton Capital Partners, which is what I'm doing right now.
And tell us a bit about the approach. You have much experience in the option world, but you're also a value investor,
right?
Which often does not perhaps go hand in hand. Or it does. Enlighten us a bit on your approach to investing.
Sure. Well, I think they do go hand in hand. And at Hazelton, we have two strategies. We have the core strategy, which focuses on creating a portfolio of about 15 to 20 different positions, equity positions. And these positions are selected based on a number of fundamental metrics that we like. But we really try to drill down on revenue, the revenue growth, and the sustainability of that growth. We also focus on the balance sheet and how robust is that balance sheet. We also focus in on the earnings power, and then we focus on the management. Are they skillful at generating cash and allocating that cash? And then the second strategy that we have is the overlay strategy. And the overlay strategy is really focused on creating, is used as a complement to the core strategy. So what we're trying to do is create short-term cash flow, as well as provide a hedge for a segment or a position within that portfolio. And some of the things that we use within the overlay strategy, some of the tools, would be risk arbitrage and mergers and acquisitions. We use commodities and currencies. We will short indexes and individual stocks from time to time. But where we spend most of our time is with options.
Well, let's talk about options then, and perhaps get back to the basics. How do you view options? How do you think about options to begin with?
So the way I look at options is they're like little mini insurance policies. And just like you'll insure your car or your house against damage or loss, you can use options as a way to protect your portfolio against financial disaster. So, and they have the characteristics that are very similar. So you'll have, just like in an insurance policy, you'll have a start date and an end date. You'll have a deductible, which in the option world is a strike price. And then you'll have a premium that you pay to own these options, and to own the insurance. Where they differ is in options, an investor has the ability not only to insure their portfolio, to buy an option and insure their portfolio, but they also have the ability to sell an option and take in the premium, whereas the only insurance companies are allowed to do that.
So tell us a bit more about the uses then of options, and perhaps some specific investment strategies that flow out of those uses.
We use options in many ways, but I would say the main 4 ways that we use it is either to enter a position or build a position into the portfolio, to exit or reduce a position. We'll take advantage if we have a certain structure within the portfolio where we feel we're finding a lot of cheap names in a certain segment or a certain industry, and we want to protect ourselves against that. We'll use options as a way to hedge that away. But we also use options as a way to take advantage of what I consider mispricing in the market. So from time to time, what you'll see is options, again, are geared towards the short-term event, like an earnings release or a product release, where an investor really wants to protect their portfolio. They want to maintain their position, but they really want to protect against if the market goes down against them because of these releases. So they use options as a way to protect it. And let's say in this particular case, they use a downside put. As more and more investors buy those put, the premium of the puts go high relative to all the other strikes along the line. So they'll develop what's known as a skew in the marketplace. And that provides an opportunity for you to sell one option and buy another and take in some premium that way, or to protect your portfolio that way.
Is there a good example, perhaps, can you give us some past example of an investment and how you used an option strategy around it?
I would say, like in the last 6 months, what we've seen in the market is definitely trending higher. And one thing that's important to understand is that when the fund looks at an option, we're actually looking at it as a secondary trade. So our main focus, as we talked about earlier, is to buy equities that we think are cheap and sell them when they either get to fair or they get to their intrinsic valuation. And so we use options as a way to enter into exit. In the last couple of months, what we've seen is the market has definitely trended higher. And we've come across some positions that we're looking to reduce or to exit out of. And so what we'll do is we'll look at the option market and we'll see if it provides us an opportunity to exit out of those positions. One of the strategies that we've been using for the past 3 or 4 months is a ratio call spread. So what that means is we will buy for a position that we're looking to reduce or to exit out of. We will buy an out-of-the-money call, and then we'll sell 2 of the strike that's right above it or near it. And in doing so, what we can do, because of the skew that's been coming into the marketplace, is we can actually take in premium to do that. So we're actually getting, in a sense, paid to exit out of a position that we would have exited out of anyway or reduced. Now, there's a slight variance that we have with that, where we actually have been taking the premium that we've been receiving and buying some downside puts or buying some at-the-money puts. And basically what that does is that basically just locks us in. So we know what our worst case scenario is going to be, where we would sell the stock, and our best case scenario, where we would sell the stock.
And for people who are perhaps not as mathematically inclined or even want to think in those terms, but are used to buying good business, good management when they see it and they can buy it at the right price, how would you perhaps explain to people and perhaps get rid of some of the misconceptions that people have about options? How do you see that when you talk to, let's say, other value investors? What are some of the things that are perhaps misunderstood when it comes to using options?
I would say the biggest, I don't know if I'd call it a mistake, but I would call it the biggest focus that most investors have when it comes to options is they look at the premium that they're going to either have to pay or sell, and they focus purely on that. And there are a lot of different variables that go into the price of an option. The underlying of the stock is one of them, one of the major ones. But also the volatility of the stock goes into it, and that also has an impact on the price of the premium that you're going to pay. Where investors, I think, go wrong is they focus purely on the premium, and they back into the trade using options that way. So, as an example, they want to buy a premium, and let's say it's 40 cents or 50 cents is what they're willing to pay, or what they have it that they're focused on paying. Then they look for a month in a strike that will reflect that 50 cents, and then they execute that trade. And they don't pay attention to the volatility level, the implied volatility level. And what you find is oftentimes they're buying the calls, let's say, out of the money calls because they expect the stock to rally in the next couple of months. And they get the fundamental movement of the stock 100% correct. But because they pay too high a premium, they end up not making or even losing money on the trade. So I think where investors go wrong with it is they don't pay enough attention to the volatility, the implied volatility. And just like as a value investor, you're only going to make money if you buy something that's cheap and sell something that's fair or slightly above fair. The same thing with on the flip side with selling options. Oftentimes people are so focused on the money that they're going to receive that they don't focus on the volatility and the uncertainty and the risk that they're taking on.
And one often hears in that context where investors look at options that, well, it's just too expensive. Options are expensive. So help us understand perhaps what you look for to determine that price of an option, and how do you think about that implied volatility? How would you explain it to somebody? How to really determine whether an option is cheap or not?
Well, the way I look at options is through the volatility. So when I decide that I'm going to look at options for a position, to enter into position or exit out of position, I'm really not paying as much attention to the premium as I am the volatility. So stocks have a historical volatility that they've created over the number of years, and that is sort of like if you want to, like a PE ratio. It's a ratio that tells where they've been and where they've gone. And by identifying what you think is a cheap volatility versus what's an expensive volatility will help an investor understand whether 40 cents or 50 cents of a premium is actually expensive. Most people tend to really focus on the absolute dollar amount. So if you say, and I've heard this conversation often, which is, well, I'm buying this option, but it only costs me 40 cents, so the only thing I can lose is 40 cents. But as value investors, we don't like to pay up for anything unless we think we're getting a good deal on it. So where I think people have to really focus more on is what kind of volatility are you paying for that? Because volatilities over the long run are mean reverting. So just like everything else, you want to buy something that's cheap because you think it's going to go back to its mean, or you want to sell something that's expensive because, again, it's going to go back to its mean.
And you do that on a stock-specific level.
Right.
Would a good proxy be the VIX index for
the
market?
VIX? Actually, the VIX is a good indication, but the VIX really gives a blanket for the stock market. Because we only deal with about 15 to 20 positions, the VIX gives you a preliminary gauge. But in order for you to really understand if you're buying something that's expensive or cheap, you really have to focus in on the stocks that you're planning to execute on.
Give us a sense of the perhaps some of the other misuses or misconceptions about options.
I think in terms of the options, in terms of the other misuses, is that people look at it as just a great way to take advantage of the market, and it's cheap. And one of the things that we focus in on the fund is that it's available to us just like all the other tools in our toolbox, but we don't use it every month. We use it when it comes available to us and it presents itself and it's a good opportunity. So just like everything else, you're not going to always buy stock every month. You're not going to buy a position every month because it doesn't always afford you a great opportunity either to enter into the position or exit out of the position. So it's more the patience that you have to maintain, and that falls along with the same thing with options.
And is perhaps a good, well, a simple rule of thumb to actually look at the VIX, and in an environment like we are today, do option strategies make more sense than when the VIX was much higher? And how is there a simple rule of thumb that one can use to say, well, it seems that volatility is not being priced correctly, and how do you think about the current environment even?
I think the VIX definitely gives you, it's like a litmus test. It provides you some sort of sense of where we are. But the one thing about options is it has a lot of flexibility to it, which means that if you want to, sometimes when an option doesn't provide you the opportunity to get involved, let's say in the buying calls, let's say buying calls are too expensive because of the high volatility, then another scenario would say, well, what if I turn around and I sell some puts against, or sell some downside puts? It's the same strategy. Selling the puts will allow you to get long the stock, but if the volatility is high enough, that might be a better trade than going out and buying calls.
What are, from an investor's perspective, some advantages and disadvantages of using options?
I think the advantage is what we've just been speaking about, is the flexibility. It provides you not only the opportunity to protect your portfolio by hedging it away or hedging some of that risk away, but it also gives you an opportunity to take in some premium as well if you found something that has a high level to it. And the other thing about options is that it has multiple strategies, whereas stocks are very binary. They go up, they go down. Options, some people can play it for the directional play of the actual underlying, and some people within options play it for the directional play of the volatility. So there's two different variables that are involved in the pricing, which are having an impact that people take advantage of. I would say some of the disadvantages are that in certain equity positions that you're involved in, liquidity might not be, especially if there's small caps or mid-cap stocks. Sometimes liquidity is not there for them. The commission structure is such that it kind of, if you're going to do a small amount, you're actually on terms of percentage of dollars that you're paying out, you're actually paying out a lot more than if you're just buying a stock. And I would say that another disadvantage that people have is that when they get involved in options without really understanding the nuances or having the experience level, they tend to focus it just as a pure leverage play for them, that they can spend a little bit of money and get a good return on their investment from it. And because of that, oftentimes they end up regretting it, I would say.
Now, you've had such a long experience in option strategies. I'm curious to hear what you found actually in your portfolio. Then, what has perhaps been the biggest challenge for you in terms of using options successfully?
I would say the one thing that you learn about through options is that they're all, like even with the VIX or any other index, you feel like there's a bottom, like a floor to it, and there's a top to it. And in most cases, if you look at it in terms of a long run, that's definitely how options tend to trade, is that when they get cheap, they hit a certain level and they sort of maintain that level. And when uncertainty arises or risks arise within the company, they'll hit another level and then they'll bounce off that level. But what 2009 taught us is that we can establish brand new levels, and those levels can then become the support and the resistance levels. So it's important that you always look upon it with fresh eyes. Even if you've traded options for a long time, have a comfort level with them, feel that you have a good sense of where a cheap volatility is or an expensive volatility is, you always have to go back and you have to, the same way you would look at a PE, you can't just look at it the last 3 years and say, well, based on the last 3 years, this is an expensive or this is a cheap PE. Based on the last 3 years, you can't look at volatility and say, this is expensive or this is cheap. You have to sort of take in the big picture, because volatilities tend to trade in a certain range, and once they break out of that, trade in a different range, and then you don't know if they're going to go back to this range or maintain this range for a while. So it's really kind of an experience level that you have to get through.
And how about in that context, the record low interest rate environment, how does an options trader think about the possibility of interest rates rising, or just the dangers perhaps of operating with option strategies when the interest rates are this low in this uncharted territory?
I think obviously interest rates play a role in pricing of an option. Not a significant role, but they do have some impact. But in terms of an individual investor who's just using options as a way to hedge the portfolio or take advantage of it, it's really more of a directional I would say, directional play. And you can then look upon it as like this, what's happening right now in the marketplace with interest rates being as low as they are, it influencing the trend of the market, which is going to influence skewing some of the calls versus a skewing of the puts. In a natural market, oftentimes what you'll see is the puts trade a corresponding put and a call. So an out-of-the-money call and out-of-the-money put in the corresponding strike will have the same volatility, will have the put level, or the put premium will be higher. The volatility of the puts will be higher than the calls, simply because that's the way people hedge themselves. That's the way they take out insurance. You take out insurance against your car, against damage. Not that the car is going to appreciate in value. And so what's happening now is that skew where you would see a huge skew where the puts were getting a bid up on a higher volatility than the calls is now starting to flatten. Still not, calls aren't necessarily higher than the puts, but that skew is coming more in line. And I think that's directly reflective of the market, the interest rate environment that we're in, and the free money that is being available to all of us.
There are a lot of investors out there who are looking to generate some income, and a lot of them are reaching for yield, so to say, and we all know that there are dangers involved there. With your toolkit and the experience in using option strategies, what is perhaps a more appropriate strategy to get income using options that you could tell us about, where perhaps the risks are not as great, or just the risk-reward trade-off is much more favorable to that?
Well, the way I'll talk about the way we look at it, and we focus in on where our main core strategy is, which is, again, buying what we think is undervalued and selling at fair. So we will look at options as a way to generate that cash flow that we were talking about earlier. Oftentimes what we'll do is we'll find it available to us in put spreads, where we can buy one put, sell two of the others. A similar strategy that we were talking about in the calls, to get out of a position, we can use that same strategy in puts, the reverse of it, to get into positions. And oftentimes, if you're looking to generate cash flow, it's available to you. Again, I would just say that it's important to really focus in on what positions you really want to add to, not just chase volatility. Because in this type of environment, what happens a lot of times is people are chasing yield. They're chasing yield in dividend stocks, they're chasing yield in any type of interest rate products where they can get a little bit extra for their portfolio. And then people will tend to move their eye over into the option market and say, well, this is just free money, because if I just sell these options, I'm taking in this kind of premium, and I only have to do it for a month, and then I can do it for the next month and onward. And it works until it doesn't work, meaning that most of the people who were willing to do that strategy didn't really want to own the stock. They just wanted the premium. And then when the stock falls off and they start owning the stock, that's the time that they really don't want it. And they end up getting out of the stock and then losing all that premium that they built up over those last couple months.
Could you perhaps talk about a position in your portfolio where you can illustrate, where you feel comfortable with the company and owning the company, and then how you've used options to generate some income and still be ready to own that business? Is there a good example?
Well, there's one example that we've been using for the last couple of months, and that's with Western Digital. Western Digital is a stock that we've owned for quite a while, and it's a position that we feel very comfortable with. Management is very good at laying out their focus in the market and how the growth of the company. And we still think it's really undervalued, significantly undervalued, and it has a good runway of growth available to it, in not just in the near future, but going forward as well. And we're always looking for an opportunity to add. In the last couple of years, what Western Digital's run into is kind of two very significant impacts on their company. One was the Fukushima nuclear reactor they used to get a lot of supplies from Japan. That impacted them as well. Then last year they had that flood in Thailand where they do a lot of their manufacturing of the products, and that impacted the stock. So both times the stock had sold off, we were able to purchase more of it at that time, and then the stock regained and continued to grow from there. The last couple of months, I would say the last 3 or 4 months, we've been looking at ways to continue to expand our exposure to the company, but we don't really want to buy it at these levels. We'd like to see the stock retrace. So we have been putting on some put spreads, something I was talking about earlier, a ratio put spread, and getting paid money to buy that if the stock gets down into the mid 40s, a little bit less, probably the lower 40s, we would buy the stock, but we're actually getting premium, we're taking in premium to do that. And this is a strategy we feel very comfortable with because we feel comfortable with the long-term vision of the company. And given that we don't really put it out too far out, so we're doing it on a month-to-month basis. And unless there's something that significantly changes within the company, we feel very comfortable with that strategy.
Now, I want to pick up there, unless something significantly changes with the company. So, by employing these types of strategies, certainly if there is a big negative announcement, then you don't really have a way to protect yourself, right? You would, based on the options you put on, you would become the owner of the shares, but where you may not have wanted to following that news release.
That's true, and you take that into consideration when you put and that's part of what we were talking about earlier with the volatility. You never really want to sell cheap volatility because something like that could happen. You never get enough of premium that's going to protect you for that downside movement. But the answer to it is you could always sell out of your puts, or in this particular case, buy back your puts, or you can just sell the stock at a certain level against those puts that you're going to be buying anyway. So you're right, you don't have the liquidity that you would have in the regular market where you have prices at significant intervals. But it's the same, I would actually say it's very similar to when you buy a stock and you have a large position in a stock and you go to sleep at night and you wake up and you find out that something has dramatically changed, maybe not only in that stock or maybe in the industry or some event that's happened where the stock opens up 10-15% lower. You don't have that ability to get out of that stock either. So it isn't like you're locked in. Options, you have flexibility. There's other things that you can do. There's other strikes within that month or corresponding month that you can use to offset those options. We don't really focus on that because, again, we're not really spending a significant amount of time trying to figure out every option play. We're using it more as a complement to the core strategy. So before we put on a position like that, we have to feel very comfortable with the company and saying, if without any type of dramatic event, this stock would just slowly trend down to this level, what would you do at that level? Would you buy more? Would you just say, okay, I'm not going to do anything? And if the answer is you would buy more, then we look to the options and we say, okay, is there something here for us that will allow us to execute that strategy that we would do anyway in the short run? And if it turns out then there is something for us, fantastic. And if it doesn't, then we just move on.
Realizing now how you employ these option strategies and the primacy really of looking for that opportunity on the equity side and then using options as an overlay strategy. I'm just curious, are there, however, any particular situations where you found that options do become mispriced in a sort of regular way, or that you've been able to exploit, or any particular events that happen with businesses or certain kinds of businesses where then you feel the options market is a good place to express a belief?
I would say two things. One is that if you follow the option market and you watch it from time to time, they actually sort of give you an indication of what other people are thinking. Because as time goes on, you'll see certain puts the volatility levels of certain puts start to go higher, and calls may be coming off, or vice versa. And one of the things that you'll see on a quarter-to-quarter basis is right around earnings release. The option market, or the front month options, will start to react. So the volatility of the front month option will start to increase because people are, let's say, buying straddles or strangles to take advantage of what they think is going to be a big movement in the stock. Or vice versa, maybe the volatility level starts to come in because people aren't expecting any type of real movement. Again, those are ways to sort of get a vision of what the market is thinking about without them, that you wouldn't get in the stocks, because the stocks are just going to move around a lot. So it gives you sort of an indication of what's happening, but also the options provide you, again, it's a good opportunity to execute a trade or execute a hedge against the portfolio that you already own. And oftentimes what you'll see is in the short run, you'll see 1 month being affected, and the next month out is staying relatively the same. So that gives you an idea that there is something that's going on. It's probably like an earnings release, or maybe it's a product release, or maybe people are thinking that something new is going to come out with, let's say, a biotech or something like that. So it gives you a sort of a good vision as to what people are thinking about the market.
So let's take an equity investor who's always been focused on just finding cheap equities and investing in them, just going long and not doing any derivatives or even shorting or any other ways of trading around those specific beliefs around a company and just going long it. What's your message to those types of investors, in terms of using options? If there is one thing that they could do, what would it be?
Well, I think the misunderstanding about options is that they're very dangerous. That people can lose a lot of money using options. Buffett called them weapons of mass destruction at one point, and I think that that's true in a lot of cases. But the thing to understand is that options are only reflecting primarily the vision of what equities are doing. So as equities continue to trend higher, out of the money calls are going to start to increase in value, and that's simply because where the stock is going. So for somebody who's purely in equities and wants to get involved in options, I would say there's a learning curve to it, that you have to feel comfortable, that you have to find out what it is that you're trying to accomplish. Because a lot of people trade options for a lot of different reasons. Some are using it, like we talked about earlier, as a hedge. Some are looking at it to take advantage and not have to put up a lot of money, sort of leverage play. There's a lot of people who trade options purely on the volatility aspect, which they don't really care which way the stock goes. They just care about buying cheap volatility and selling high volatility. So just like an investor, you would give suggestions to an investor to say, find your niche or find out what you're good at, focus in on that. I would say the same thing about options, which is that find out which part of the option that you want to use to your benefit, and then figure out a way that it dovetails with your strategy.
And certainly there are lots of books on options, and a lot of them tend to be very mathematical, as you would expect. Is there perhaps a good resource for equity investors who are not perhaps so mathematically inclined to understand the theory behind options, but to perhaps look at some practical examples and perhaps approach it that way? Or would you say don't do it if you're not prepared to understand the mathematics?
There's a lot of good books out there. There are a lot of good courses out there that are taught on options as well. A lot of them, like you said, tend to focus in on the mathematical pricing of an option. And I would say don't really worry about the pricing of the option. Get an idea of what goes into the price, sort of like, you know, with a cake, let's say. You know that there's eggs, you know that there's sugar in it, but you don't know the ratios, and it really doesn't matter if it tastes good. So with options, I would say just sort of get a good understanding of it. Don't really worry about all the different pricing models that are out there. Find something that you're comfortable with, and really kind of drill down into figuring out if this strategy, if options really works for you. Because to be honest with you, it doesn't really work for everybody. Because some people are purely involved in their equities, and they have a comfort level there, and they don't want to be distracted by the options, and that's fine. Other people are looking for ways to add a little bit of yield to their portfolio. Options may be a great opportunity for them. But again, there's with all the flexibility that it has, with all the nuances that options have, it really depends on how each individual investor wants to use it.
Well, on that note, Barry, I'm going to leave it there. Thank you so much for sharing your insights into options with our audience.
Well, thank you.